Gold is winning. As the current political and economic environment gets messier, gold continues its long uptrend, reminding everyone how it got its reputation as hard money. And while central banks are stacking bars and retail investors are hoarding coins, commentators are speculating whether we're destined to return to a gold standard. So, are we actually heading back to a world where money is once again backed by metal? Or is there another way gold could play a bigger role in the economy? Today, we'll look at what a gold standard really is, whether it's possible in 2026, and what all of this could mean for markets. My name is Guy, and you're watching Coin Bureau Finance. First up though, I must make one thing clear. I'm not a financial advisor, and nothing in this video should be considered financial advice. This is just our take on gold's place in a changing world order. And if you want to see more stuff like this, then hit those like and subscribe buttons and flick that notification bell too, so you don't miss the next video. Okay then, let's start with the basics and define exactly what the gold standard is and clear up some confusion around the concept while we're at it. So, a real gold standard is a hard set rule. The government sets a fixed conversion between its currency and an agreed quantity of gold, and stands ready to swap one for the other. If you can show up with cash and demand metal at a set rate, then policymakers can't expand the money supply forever without eventually getting checked by, well, people taking the gold. So, when did we last see something like this in a major economy? Well, after World War II, Bretton Woods put the dollar at the centre of the global financial system. The US fixed the dollar to gold at $35 per ounce, and other major currencies fixed themselves to the dollar. Just to be clear, there was a gold anchor for the system, but it wasn't quite the setup where citizens were routinely redeeming notes for gold. Nevertheless, the global economy was still anchored by a gold exchange standard. But then the anchor was abandoned. In August 1971, the US, under President Nixon, ended convertibility of dollars into gold, the famous closing of the gold window, which helped bring the Bretton Woods system to an end. So, when you hear speculation that gold taking centre stage could take us back to a gold standard, the question is, back to what exactly? The strict version, where money is literally a claim on metal, or a derivative version where gold sits in the background as a confidence asset? Because right now we're in a fiat world. Your currency isn't a receipt for gold. It's an obligation of the issuer, supported by institutions and enforced by the state. And the reserve assets that dominate global finance are mostly liquid government bonds, not stacks of bullion. Now, to get an idea of the scale here, the IMF's Currency Composition of Official Foreign Exchange Reserves, or COFA release, put total global foreign exchange reserves at about $13 trillion in the third quarter of 2025. In that same quarter, the US dollar's share of disclosed global currency reserves was at just under 57%. So, love it or hate it, the dollar is still king. Now, when media commentators talk about a gold standard in the modern era, they can have a few totally different things in mind. Sometimes they mean central banks are accumulating many tons of gold, which they are. Sometimes they mean gold-backed stuff, gold-linked settlement, gold as collateral in trade, or tokenized gold. On that note, it's worth remembering that heaps of gold in government vaults does not translate to a gold standard. Just look at the United States. The federal government currently owns roughly 261.5 million fine troy ounces of gold, spread across places like Fort Knox, West Point, and Denver. That is, if you take their word for it, of course, but well, we won't go there now. It's also worth noting that the US Treasury still books that gold at the statutory $42.2222 per troy ounce, set in 1973, an accounting relic of the post-gold standard transition. But sometimes the headlines grabbing your attention are referring to the classic version. A major economy fixes its currency to gold at a specific price and commits to convertibility. That's the real gold standard as most economists consider it, and it's a very drastic policy choice because everything has to bend around defending that peg. Much more on that later though. Now, unless you've been living under a rock, you've probably heard a lot of talk about gold recently. But why now exactly? Why is gold taking centre stage? Well, to help answer that, we can look at the biggest gold buyers in the world, central banks, and their motivation for accumulating the precious metal. Central banks have been buying gold hard. The World Gold Council estimates they added just over 1,000 tons to global reserves in 2024. There are no finalised stats for the full year 2025 yet, but the World Gold Council reported 634 tons of net central bank buying through Q3 and estimated 750 to 900 tons for the full year. And this isn't a random blip. Central banks have been net buyers for 15 consecutive years since 2010, likely buying well over 9,000 tons in that period, depending on the official tally for 2025. So, what are the reasons for this aggressive buying? Well, for starters, gold does not rely on another government's politics or legal system. And in the last few years, reserve managers have been reminded, very publicly, that so-called safe assets can become politically complicated, to say the least. After the Russia-Ukraine war broke out, Western countries froze a huge chunk of Russia's sovereign assets, over $300 billion worth. For any country watching, that was a stark reminder of real risk. If the asset is held inside someone else's jurisdiction, it can be taken off your hands. And things have only escalated from there. In recent months, the EU has been using profits from frozen Russian assets to help fund Ukraine's efforts against Russia. This only boosted central bank gold buying because it increased the perceived vulnerability of reserves held abroad. But that's only one part of the story. Gold demand also stems from a broader geopolitical shift. The post-Cold War rules of the game have deteriorated in recent years. Trade relations are far more tense, and US policy direction has been a bigger source of uncertainty. And there's no doubt that a big chunk of gold demand is coming from all of this geopolitical uncertainty. That source of demand also happens to span both institutions and regular people. Institutions buy gold when they don't like their alternatives. Regular people buy gold when they're not feeling great about the future. And one clear example of this is China. Chinese investors piled into gold funds at a record pace in 2025, with China driving a large share of global gold ETF inflows. But then we come to arguably the most important fundamental driver, and that's debt. According to IMF figures, total global debt is just above 235% of world GDP. That's around $251 trillion US. When debt sits that high, there's a growing assumption that governments will manage it by keeping interest rates low for long stretches and letting inflation relieve the real weight of that debt. That's the belief behind the debasement trade. That is, some believe governments are now forced to let inflation steadily eat away the real value of their currencies over time. This is why you may have seen the term financial repression thrown around recently. That just refers to policies that suppress what savers earn relative to inflation. If you're a central bank holding foreign bonds as reserves, that's a dynamic that makes a larger gold allocation look attractive. And the buying hasn't stopped. World Gold Council data shows central banks were net buyers again as recently as November 2025, with reported purchases still elevated compared with earlier months. And from early price action in 2026, it would appear that demand is still strong. And by the way, if you want to stay on top of that price action, along with everything else macro and politics related, then you should sign up for the free weekly Coin Bureau Finance newsletter. We also have exclusive deals for Coin Bureau Finance viewers, discounts, bonuses, and promotions on tools that might help you navigate this trend in precious metals. The newsletter is absolutely free, and the deals we have are exclusively for the viewers of this channel. So check them out. And now, back to the video. So, central banks are buying tons of gold, and everyday people are losing faith in fiat currency systems that have enabled countries to rack up record levels of debt. But we have to ask the obvious question: could a modern economy actually run on a hard gold standard again? Well, strictly speaking, in theory, yes. Governments can pass a law, set a conversion rate, and commit to exchanging currency for gold on demand. But in practice, the moment you make that promise, you've shaken up the whole system as we know it today. And if markets think the peg won't hold, they'll be eager to call your bluff. The first issue here is scale. Modern money isn't mostly paper notes. It's actually bank deposits and credit sitting on top of central bank money. If we focus on the US, M2, a broad measure that includes cash and many kinds of deposits, was about $22.3 trillion as of November 2025. Now, technically, under a gold standard, you have to define what is truly convertible. But when confidence cracks, panicked people behave as if everything is. Even in the old days, gold standards weren't usually 100% backed in a simple way. They relied on trust, fractional reserves, and the expectation that not everyone would demand metal at once. In a modern financial system that's built on leverage, that trust threshold is even more important. But there's also the metal itself. The World Gold Council estimates total above-ground gold is around 216,000 tons, and only around 17% of that is held by central banks. Most gold is jewellery, private bars, and coins, or embedded in industry. What's the significance of that? Well, a government that wants a meaningful gold anchor has limited options: acquire a lot more gold, restrict convertibility, or set a gold price high enough that existing holdings can credibly support redemption. In the US, that could mean marking up the gold that is technically held on the books at that funky $42.2222 price tag. This is where the argument for gold discipline has a point. Under the classical gold standard, governments had less room to expand money creation at will. It constrained excessive printing and imposed fiscal discipline. If that kind of constraint had been in place for decades, it likely would have changed the path that produced today's debt mountains and recurring inflation scares. But that doesn't make it a clean fix today. You can't switch back the regime without forcing painful adjustments elsewhere. Credit would have to tighten, rates would need to defend the peg during outflows, and deflation pressure could reappear in a very aggressive fashion. It's a bit like trying to put toothpaste back in the tube. We also can't ignore the practical hurdle here: incentives. A hard gold standard reduces policy discretion by design. That means the powers that be would have less ability to tweak policy in any given direction. That is, of course, particularly true for monetary policy. Because the gold standard determines the money supply, there's limited scope for monetary policy. But we're not just talking about central bankers here. Politicians, policymakers, and the interests that influence them would prefer keeping their hand on that lever of power. Surprise, surprise. If a country like the US were to announce a gold standard, markets would also ask whether the promise survives a crisis. And history gives us some insight here. Roosevelt-era policy showed us how gold constraints shaped choices in the Great Depression of the 1930s. It also showed us how quickly policymakers moved to change the rules when the domestic situation demanded it. And on top of that, there's the issue that a gold standard is effectively a fixed exchange rate commitment. With free capital flows, that means giving up independent monetary policy. That's the essence of the so-called monetary trilemma, which we won't dig into right now. But the point is that if you want a true gold standard in a globally connected financial system, you're accepting that defending the peg outranks domestic stabilization. In the words of Thomas Sowell, there are no solutions, only trade-offs. Okay, so the US isn't likely to give up the weapon that is a fiat US dollar in favour of a gold standard. But what about other countries that are sick of the US dollar? Enter the BRICS countries, and the speculation around a possible gold-backed currency regime to get away from the greenback. But before you get excited, let's just dispel some of the rumours first. A single BRICS currency isn't on the agenda. Brazil's BRICS presidency in 2025 stated that it was not going to pursue a common currency, even while looking at ways to reduce reliance on the dollar in trade. Similarly, Russia has publicly stated that BRICS isn't planning its own currency and that the focus is elsewhere. And structurally, that makes sense. A shared currency needs coordination on fiscal policy and monetary policy, let alone one anchored by gold. But just because a single currency isn't on the cards doesn't mean a gold-guided system isn't making a comeback through BRICS. A more plausible BRICS gold scenario isn't a full gold standard, but gold as a settlement or collateral layer behind local currency trade. Commentators have noted proposals floated in and around BRICS discussions where a common unit could be part-backed by gold, even if it never becomes day-to-day money. Previously, Russia said it was in talks with BRICS partners about an international precious metals exchange. This could theoretically tie bullion infrastructure to the broader push for alternatives to Western-dominated systems. But it's not just the BRICS countries in the mix here. Smaller countries have tried gold-linked money domestically, usually because their fiat credibility was already damaged. In 2024, Zimbabwe introduced a new structured currency backed by gold and foreign currencies, hoping it would be more stable. However, that's not the same as a stable major economy voluntarily giving up flexibility. And for countries reliant on the US dollar that are thinking of opting for some form of gold standard, there's also the possibility that this comes with major consequences. Consider Libya back in the early 2010s. Then-leader Muammar Gaddafi wanted a gold-backed currency to be used in international oil transactions, aiming to turn away from the US dollar. And many argue that this was central to him being toppled. So, although there may be reasons for some specific countries to opt for the shiny metal, that transition is not likely to be easy, sometimes for reasons beyond basic economics. But let's take this back to the major economies. Gold doesn't appear to be slowing down anytime soon. So, if bullion is to play a bigger role in major economies through one form of gold standard or another, what impact would that have on the markets? Let's first look at the full version, a major currency becoming legally convertible into gold at a fixed price. Now, today's system runs on elastic credit. Once you lock the currency to a metal, the pressure valve becomes interest rates and liquidity. And if investors doubt the peg, they will act. That tighter credit usually means higher rates in stress and sharper downturn risk. It also turns foreign exchange into even more of a battlefield. A hard gold peg is effectively a fixed exchange rate commitment, which forces a choice between defending the peg, keeping capital flows open, and running independent monetary policy. And that takes us to bonds, which would be hit hard under a gold standard. Under a true gold standard, governments can't lean on central banks in the same way, because unlimited support can clash with convertibility. In the transition, investors would demand a bigger cushion for holding long-dated bonds, because the policy tools to adjust are more limited. Equities would undoubtedly feel it too. If policy can't cut rates or inject liquidity when the business cycle turns, risk premia rise and valuations usually compress. Banks and highly leveraged sectors would be the first in line for the pain, and there would be a lot of it. And despite all the de-dollarization talk, the existing system is still enormous. Foreign holdings of US Treasuries hit an all-time high of over $9.3 trillion in late 2025. In the official Treasury data, Japan alone holds over $1.2 trillion. And that scale tells you why any sudden shift would be chaotic, to put it mildly, and why reserve managers still prioritize liquidity and depth. At the same time, however, there's a notable nuance in the marginal trend. US Treasuries held at the New York Fed on behalf of foreign central banks fell to $2.72 trillion in December 2025. That might sound like a lot, but it's actually the lowest since 2012. If big holders want less exposure to US risk, diversification follows, and gold is the obvious option. So, instead of a hard pivot to a gold standard, the more realistic market impact to expect here would be something gradual. Gold will undoubtedly play a bigger role in reserves, and we may see some trade settle on infrastructure that reduces reliance on the dollar. That doesn't erase US dollar demand, but it can shift the market with more demand for neutral collateral and stronger structural support for gold. And for investors, this is actually pretty straightforward. Although a gold standard may have saved us from the bind we find ourselves in today, implementing it today would be disruptive for rates, credit, and growth-sensitive assets. A partial shift towards gold as reserve collateral is less dramatic, but it's still a big deal when global foreign reserves stand at around $13 trillion. So, gold is likely going to play a bigger part in all of our lives over the coming years. Just don't imagine you'll be able to show up to your local bank with a load of paper money and walk out with a bar of something yellow, heavy, and shiny for your trouble. Well, that's our outlook on the growing speculation around a new gold standard. But what do you think? Would a gold standard actually improve things? Is it unfeasible? Or are the powers that be just standing in the way? Let us know your thoughts down in the comments. And if you want to learn more about what those BRICS countries are up to with their gold, you can check out our video on that right over here. That's all from me for today though, so as always, thank you for watching and I'll see you in the next one. This is Guy, signing off.